Understanding protective puts, an effective hedging strategy. A protective put is a savvy risk management strategy utilizing options contracts that investors utilize to safeguard against potential losses associated with owning a stock or another asset. This strategy comprises purchasing a put option, a financial contract that grants the holder the right, but not the obligation, to sell a specified amount of the underlying asset at a set price before a specified date, while holding the underlying stock. Through this approach, investors create a safety net that helps mitigate downside risk while still allowing for growth. What is a protective put? Definition. In simpler terms, a protective put functions as an insurance policy. An investor might purchase a put option for a fee known as a premium to protect against the risk of a downturn in the value of their underlying asset, like a stock. While puts are generally seen as bearish strategies, where a trader anticipates a decline in asset value, protective puts are unique because they are often adopted by investors who maintain a bullish outlook on a stock or asset but desire some protection against potential losses. Coverage options. Protective puts can be applied to various asset types, including stocks, commodities, currencies, and market indexes. Investors view this strategy as essential for managing risks associated with holding these assets. Key takeaways. A protective put serves as a risk management tool to guard against losses. For the cost of the premium, it provides downside protection against asset price declines. It allows for unlimited upside potential since the investor also retains ownership of the underlying asset. When the protective put covers the entirety of the long position, it is known as a married put. How does a protective put work? Mechanism. Protective puts are often employed when an investor holds stocks that they intend to keep in their portfolios for an extended period. The risks associated with owning a stock include price decreases that could lower the value of the investment. By purchasing a put option, the investor effectively sets up a floor price, meaning their losses are limited to a predetermined level should the asset's market price decline. Put option defined. A put option gives the owner the right to sell a specified quantity of the underlying security at a predetermined price, known as the strike price, before a specific date, the expiration date. Unlike futures contracts, buying a put option does not obligate the holder to sell the asset but allows them to do so at their discretion. Factors influencing options pricing. The premium paid for a put option is influenced by various factors, including current price of the underlying asset. The relationship between the market price and the strike price determines the option's moneyness. Time until expiration. Options lose value as they approach their expiration date due to time decay. Implied volatility. For higher perceived future volatility can lead to higher option premiums due to the increased probability of price movement. Moneyness of options. The moneyness categories typically include 1. At the money, ATM. The strike price is equal to the current market price, thereby offering maximum protection until expiration. 2. Out of the money, OTM. The strike price is below the market price. Using an OTM put generally lowers the premium but introduces some risk of loss. 3. In the money, ITM. The strike price is above the market price. ITM options come with higher premiums but provide less downside protection. Investors seeking to hedge losses typically focus on ATM and OTM options. Potential scenarios with protective puts. Upsides and downsides. Through the protective put strategy, investors can benefit from stock price increases while being safeguarded against any significant downturns. If the stock's price surges, the put option may expire worthless, but the investor only incurs the premium cost as a loss. Conversely, if the stock price plummets below the put strike price, the put option provides a selling price that limits the loss on the stock. Real-world example. Consider an investor who purchases 100 shares of General Electric Company, GE, stock at $10 per share. Later, the stock price increases to $20, but the investor wishes to protect their unrealized gains. The investor might purchase a put option with a strike price of $15 for a premium of 75 cents. This sets a minimum sell price for the shares of $15, even if the stock price declines. 1. If the stock falls to $10, the investor can exercise the put option, minimizing losses and securing $4.25 profit per share. 2. If GE shares rise to $30, the investor realizes a profit of $1,925 after deducting the premium from the total gains, thus effectively using the protective put to hedge while still participating in potential gains. This example underscores how protective puts can operate as a form of financial insurance, allowing for peace of mind while strategically managing investments. Conclusion. The protective put strategy represents a valuable tool for investors looking to manage risk while still capitalizing on potential market gains. By allowing investors to hedge against price declines, protective puts empower them to maintain their bullish positions on stocks or assets without exposing themselves to significant losses. While the premium costs may seem like a drawback, these costs provide a safety net that can be crucial during volatile market conditions, offering both protection and the potential for profit. Understanding how to effectively utilize protective puts can enhance an investor's strategy and contribute to a more balanced portfolio.